Aristotle made a mistake about a rolling cart that took the world 2,000 years to figure out. And that exact same mistake is hiding inside almost every single losing trade you've taken. Today, we're going to find it. Welcome to Physics and Trading. This is a 5-part course on the physics behind how markets actually move and how to trade with that physics instead of against it. In episode 1, we're going to start with the law of motion. So let's come back to Aristotle's cart. If you push a cart across a floor, it rolls a little and then it stops. Aristotle watched this happen thousands of times and drew what felt like the obvious conclusion. Objects naturally come to rest. In his view, motion was the strange thing, the thing that needed explaining, while stillness was the default. He wrote that down, his students taught it, and for the next 2,000 years, nearly every educated person on Earth believed exactly that. Then, in the early 1600s, Galileo started rolling balls down inclined planes. And instead of focusing on the stopping, he focused on the distance. So the smoother he made the surface, the further the ball traveled, he noticed. The surface went from wood to marble, marble then became polished marble, and each step, each iteration reduced the resistance, and each step extended motion. So he pushed the idea one step further. If you removed friction entirely, what would happen? His answer was simple, yet radical. The answer was if you remove friction, the ball wouldn't stop at all. Now, that simple little insight is what changed everything. Motion wasn't something that faded on its own, there was something actively removing it. And that something is what we call friction. Friction is an invisible, constant, and completely overlooked force by everyone before him. About 80 years later, Newton then formalized this into a single law that you've probably heard of. An object in motion stays in motion, an object at rest stays at rest until a force acts on it. Now that's the real shift. Aristotle thought motion needed a cause, but Newton showed that change is the thing that needs a cause. Motion doesn't really need much explaining. Speeding up, slowing down, or reversing, those are the only moments that actually need some sort of a reason or explanation behind it. And that exact principle is what we map onto price charts. Now, before we do that, we need two more concepts from physics that will allow us to build a complete picture. The first concept is the concept of inertia, an object's resistance to any change in its motion. So, for example, the bowling ball resists change more than a tennis ball. You feel it immediately when you try to stop one. Imagine having both rolling towards you. It's a lot easier to stop the tennis ball than it is the bowling ball. The second concept is momentum. Momentum is mass multiplied by velocity. A heavy object moving slowly can carry the same momentum as a light object moving quickly, and in both cases it takes the same amount of force to stop them. So let's bring this now all back to markets. A trend is a body in motion. And when a stock might be trending for, say, 3 weeks, that's not necessarily random. That's momentum expressing itself over time. And this is where most traders fall back into Aristotle's mistake. They assume that this trend should naturally fade and that it's somehow due to stop. But trends don't stop on their own. Something has to stop them, whether it be earnings, a Fed announcement, liquidity drying up, maybe buyers or sellers running out of orders. There needs to be some sort of catalyst. Every reversal has a cause. The problem is most traders wait until the chart shows this reversal before they go and look for it. Your job is to think in the opposite direction. Find the force first, and then you're waiting for the change. Now let's talk about mass. In physics, mass determines how hard something is to move or redirect. In markets, the closest equivalent is liquidity and float. So if you use SPY, for example, and you compare SPY to a small cap stock, SPY is a freight train. It takes sustained and significant force to change its direction. There's a lot of institutional money behind SPY. Contrast that with a small cap stock, with a tiny float, for example. That's almost like a tennis ball. It can reverse instantly on a single headline. This is why the exact same setup behaves differently across tickers. It's not inconsistency, it's just physics being applied to different masses or bodies of masses. Now we take one more step forward from concept into execution. Every single trading day, pressure builds before the open in pre-market. from the previous close, from the overnight session, news, earnings, positions accumulating, especially now with 24/7 trading. But price can't fully express that pressure yet, and you see this with the 9:30 open. No matter what, at 9:30, you'll see an explosion one way or the other, a volatility eruption, if you will. The open is that release. It's that first 5, 15, and 30 minutes where you can really start to measure that release. That's your first real read on this momentum, this pressure that's been building up. And that takes us to the opening range breakout as a concept that we can now tie back into physics. It's not just a simple pattern, it's really Newton's first law on a chart. You're letting price establish its initial velocity, and then you're waiting. If price breaks that range with conviction, you're seeing momentum continue without an opposing force. At that point, you're not really predicting, you're aligning with motion that's already been confirmed. But momentum alone doesn't complete the picture. There's still one more question left, which is how far can it go? In physics, that depends on the environment. A bowling ball rolls much further on marble than it does on sand. In markets, that environment is volatility. Volatility is the energy that is already loaded into a stock before the actual move begins. The higher the volatility means a larger potential range. The lower the volatility means tighter movement. Now, again, this is another place where most traders misread the situation. They focus only on direction, or delta if you're trading options. But direction tells you where. Volatility tells you how far. That's why even volatility box models matter. They don't predict direction, they define the boundaries of the move. Before the open, you should already have a statistical expectation for that particular day's range. That becomes your framework, your target, your stop, your runway. It really helps dictate everything around the trades you take, directions, volatility, etc. Now, that was episode 1, and we learned some key foundational concepts. We're going to build on all of the concepts we learned from here. Energy, oscillation, temperature, and phase transitions are what you can look forward to in the next 4 episodes. By the end of this mini 5-part series, you'll have a complete framework for reading any market through the lens of physics, which I think will add a massive edge with a mathematical component to how you view the markets. Until then, take this with you, at least from episode 1. Things keep moving until something stops them. So, on Monday morning, for example, ask yourself 2 simple questions. What's in motion? And more importantly, what could stop this particular motion, whether it's bullish or bearish? See you in episode 2.